Good morning, everybody. Thrilled to kick off this Traders Corner January Summit. As Rob said, I know we've got a bunch of great speakers lined up for you today, but let's start with high win rate. Looking for how to get the majority of your trades winning goes a long way to boosting your trading confidence, your belief in what you're doing, and your frankly ability to continue to execute it consistently over time. So we're going to walk you through how we use credit spreads to do that. And just as we get started here, I just want to remind you that the information provided in today's presentation is based on our proprietary research and it's intended for illustrative purposes only. These should not be considered specific advisory recommendations today. As you know, stock and options trading has large potential rewards, but also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. Do see our terms of use on our bigtrends.com homepage for more information in this regard. So with that behind us, if you don't know me, I've been trading personally for 33 years. I caught the trading bug when I was down at Duke University, and upon graduating from there, was an analyst and then director of research for the nation's biggest options newsletter at the time, and then started bigtrends.com back in 1999. So we just had our 23rd full year anniversary back in November. So when I launched Big Trends, it was all about data, having time-tested research strategies that give you a quantitative trading edge is what it's all about for me. We've been blessed to serve many tens of thousands of clients all over the world. And I was blessed to be inducted into the Traders Hall of Fame, sponsored by Traders Library back in 2007. There's a little picture of the award they gave me, but more important was the company that I joined, of just a lot of trading legends in that list. And my goal for you, I call it standing on the shoulders of giants, is to stand on my shoulders and the shoulders of others that are going to follow here today to really shortcut a lot of the potential mistakes that you can make and actually say, let's get past those and get on to how to be more consistent, more effective in your own trading approach. Was blessed after launching Big Trends back in late 99 to appear less than a year later, September 2000, where I actually said, watch out below. It was really unusual to me that we saw so much bullishness as 2000 kicked off, but it was all about the tech bubble. Remember, everybody had been worried about Y2K coming into the 2000s. And then once that fear was gone, it was like everybody was buying the dip. And I said, this is not a good sign. We need to flesh this out. And as you know, turned into a couple of years of a rout for the tech stocks on the downside. And 2002 said the same thing. We're not done yet. And talking about both bullish and bearish, but mainly bearish conditions at the time. You say, well, what's the condition of the market now? We've taken a lot of the fluff out of the tech stocks. There's still, have been a bit of a weight on the S&P, but as you know, there's been a lot of other areas to profit from, like energy and frankly, a lot of other individual stock names that we've been trading. If you look back at our 2022 success rate using credit spreads, we were generating 72%, 72.41 officially. But, my goal is to do 3 out of 4. Typically I want to do even like 75% plus. But hey, 70% plus works just fine for this strategy I'm going to share with you today. And sometimes we'll do even better than that, sometimes worse. But the idea is that over time, it's about how you average out to have a lot more winners than losers. Now, one of the things I'm going to share with you today is not one strategy, but actually 2 different techniques. One is a momentum trend following strategy for individual stock credit spreads. And we're going to get into what credit spreads are as well. So don't worry about that if you haven't traded them before. But with the broader markets, we use more of a reversal, kind of a trading range type of a overbought, oversold philosophy to kind of find the turning points in the broader markets. And we'll teach you how you can not only look for these signals, but also how you can get my top signals called out in real time for the rest of 2023, for the next year, essentially. Take advantage of that. One of the things I asked for you throughout today's speaker talks, including mine, is to get your full attention. That's a challenge for a lot of folks with cell phones buzzing and ringing and internet searching and emails popping up and everything. But the reality is, if you try to do too many things and multitask, you're going to actually lower your IQ. We want to enhance your trading IQ. And this information is something that's been learned by me over 3+ decades of trading experience. So I encourage you to really focus yourself so you can look at how you can win on the majority of your trades. When you look at what we're seeking to do and how we target, not big gains per trade, okay? So it's more of a singles approach compared to the usual home run approach a lot of people talk about with options. But we actually say, let's actually change the goal into a high win rate goal, control our risk when it's not working. And basically, the beautiful thing about this method, if you're only targeting a 25% return on a given trade, is saying, okay, and we might even take in less than that, maybe even close it out early and take 20% of our gain, a 20% gain in a matter of days, and say that works just fine to keep building wealth. And you collect this cash up front. You're actually, instead of being the premium buyer, you're being a net premium seller. We're going to get into credit spreads in a minute, but the idea is that you pocket money up front, kind of like the insurance company, takes your insurance premiums when you buy insurance on your car, on your home, protecting those assets, that nothing bad happens to your home or car, I hope. And bottom line is that you are glad that nothing bad happened and you pay that premium. The insurance company is the one that's collecting those premiums up front. And every once in a while, sure, they get a ding from a car accident or a house problem. But the reality is that they're still making billions and building monster headquarters, and their stocks are doing well. And bottom line is that it's about, the fact that the majority of those trades are winning for them on those policies that they underwrite. So you become kind of like the house, the insurance company in this example. Looking back, all the trades we closed in our credit spread trader program, which is our stock-based system, 72.4% win rate last year. So we're going to walk you through the stock-based system. It generated 64 trades over the last 2 years. That's not a ton of trades. That's like essentially maybe like you can see less than a trade a week. But that's why what I did is I actually said I doubled up my credit spread offer today to include my index options timer strategy, which is tracking the S&P 500 and one other key index I'll talk about today, but S&P is definitely the biggest. The SPY, as it's called, the SPY. When you add those trades in over the last 2 years, we've generated 152 trades. That's like a trade and a half a week in 104 weeks, 152 trades. So now you start to get into where you're seeing 1 to 2 trades a week on average, and then actually the profits start stacking up. Past performance doesn't guarantee the future. The future is going to vary, but the reality is, looking back over the last 2 years of results, when we add in these two portfolios, both a stock-based credit spread system and the S&P and ETF-based systems together, generated a $36,000 total profit over the last 2 years, assuming you use a $10,000 per trade investment. For a lot of people, that's probably out of their reach. If you were using $1,000 a trade, cut it down, that'd be a $3,600 gain. That's still a lot better than a lot of people did with the bear market last year, where I talked to a lot of people who gave back all their profits, or worse yet, lost more than what they made the year before because they were tech heavy and frankly in the wrong sectors, the wrong stocks, the wrong positioning. So the beautiful thing about this approach, folks, is that you don't have to make kind of a buy and hold view on the markets. You can be in and back out typically in a matter of days. Okay, we usually use options that are going to expire in about a week to 10 days. And you say, why would you use such short-term options? Because you're actually now benefiting in the strategy from the passage of time. So let's talk about an example. If you heard the term put credit spread, that's actually a bullish or neutral view on the market, but you're actually now betting, instead of betting on a big rise, which, if you're betting on a bullish view, you usually think, well, I've got to buy a call and hope it has a big move in my favor. Your goal has changed now. Instead of having to have a big move in your favor, the goal here is, let's set it up so that as long as we don't have a big dramatic move against us, we can win in a bigger number of scenarios. So in this example, if the stock's at 47, most people would say, well, it's got to go to 49, 50, 51, 52 to start making money on a call trade. Sure, we win in that scenario here, but you know what? We win if it's flat at 47 at the expiration. We even win if it drops down here to 45 bucks at the expiration. So 45 or higher, we're a winner when we sell a 45 put and then buy a cheaper put below that to protect ourselves. In this example, it shows a 5-point spread, A lot of times, even on cheaper stocks, we'll use a even tighter risk management now of a 1-point spread. We'll show you some examples of that. But bottom line is that, look, think about what we're doing here. We're selling a 45 put. We're never naked. We always simultaneously buy another option to protect ourselves in case we are badly wrong. We've limited our maximum downside risk. In this example, at 40 or lower at expiration, you'd lose 300 bucks. And you say, why would I do that if I'm only collecting in 200 bucks up front that I'm trying to pocket on the trade? Because the vast majority of trades are going to make you money. And if you can win, roughly, in this case, say you win 3 times and lose once, you would have a 75% win rate. You would make 600 bucks on the 3 times that you're winning. If you're totally wrong, you don't have any risk management, which of course we're trying to always improve our risk management and keep our loss at about half of our maximum risk. But even if you took the maximum $300 loss 1 out of 4 times, you'd make 600, lose 300, you'd be up 300 bucks over 4 trades. That's not a home run by any means, but it's still positive, and it's still keeping you green and growing, as I like to say, in your portfolio. And of course, we're all about keeping our subscribers' knowledge growing. So we do a lot of weekly updates, and in addition to email and text updates to your smartphone. So more on that later. But the goal here is that you're saying, as long as the stock is not badly against us, we're in good shape. Look at what your break even is even on this strategy. Start at 47, at 43 at expiration is where you break even. Why? Because now it's 2 points down below the 45 put that you sold. Remember, if you're new to options, a 45 put is basically a situation where if you sell a 45 put, you're saying, I will buy the stock at $45. Now, if it tanks to 30 or something, that's where you have a big problem, right? So that's why you're buying the cheaper put below it to say, in case it goes below 40, I'm protected. And then in between 45 and 40 is where you're saying, okay, it's going from a profit at expiration down to a break even at 43, down to a loss below 43 at expiration, right? So the idea is that typically under the break even at expiration levels where I don't want to hold this trade, or if we're losing half of our maximum risk. So if we're risking $300 a contract, if we're down 150, if we're taking basically a 50% give back on that, then yes, we're going to close it out typically early, unless there's just some massive gap against us. So the one massive gap scenario you should avoid with credit spreads is right in front of big events like earnings. So in an earnings situation, you're not, even though the options look expensive, you're not actually a net beneficiary of all that volatility, because you're selling one high volatility, you're buying another high volatility. Really, credit spreads are a time trade, and so it's about putting time on your side. Cue the Rolling Stones song. Yes, time is on your side, the way we do them with the big trends approach to credit spread. So let's look at an example on the individual stocks of a put credit spread from our credit spread trader program. This is one that we did recently on MasterCard. You can see we kicked off 2023. MasterCard's had a great start to the year. And you see that for our system, though, what we're looking for is a breakout, not just to incremental new highs, which is what the green channel shows us, but that it's also closing above our band, saying that this pink color band here is saying that we've got some velocity and the continuation of this trend that we think can happen, in this case over just 3 trading days. We hopped into MasterCard, you can see back here around the 9th, and then we basically close it out around the 12th. So we're in and out in the same week. And an option, notice that is a weekly option. Every Friday is a weekly expiration. In this case, it was the second Friday. This was the January 13th expiration, second week options. And what we did, the way the credit spreads are shown here, is we sold the first leg. We sold the 362.5 put. Then we bought the 360 put. Now that's a 2.5 point spread. That's $250 of risk per contract, but your broker's only going to require you to hold that differential minus what you collect in a credit. For us, it was 50 cents or $50 a contract on a 2.5 point spread. That means 2 points or $200 of max risk is what your broker says you must hold, is what's called your margin requirement. That's not a big concern, because we're saying, look, that means that we can collect 50 on our 200 bucks of max risk, and that's your 25% return potential. Now notice, we didn't hold it to expiration in this case. We said, let's take the profit early, buy it back in for 7 cents, that's $7 a contract. So on a typical $1,000, max risk for a starter account, that basically you'd be doing 5 contracts, taking in $250. We buy them back in at $7. So that means we buy them back in for a total on 5 contracts at $35. So before commissions, you're pocketing a $215 profit, which is that 21.5% return on that 1,000 that you invested in 3 trading days. So, you see the stock later tanks off, but again, that's part of why we take that sort of bird in the hand approach with this philosophy, is that if we can make at least a 20% gain, whether it's in a day, 2, 3, 4, 5, these trades, and this one you can see had, roughly about a week and a half to go, actually about a little over a week to go before expiration, and saying, look, okay, we can take that money off the table a little early and book the sort of enhanced win rate strategy, right? If you have a 20% gain, you let it slip away to a loss, there was a nice win rate lost that you would basically be kicking yourself over. So we find it's better to go ahead and close these early. Commissions are a much smaller part of the equation than when I got started in my trading back in 1990 in options. I remember ticket charges were $30 to $50, even if you traded 1 contract. Now they're less than $1 a contract, typically with no ticket charge, right? If you're paying too much in commissions, that's one of the first actions you should take is call your broker, and if they won't lower your rate, switch brokers, right? Because it's just the best time in my 33 years of options trading to trade options and keep the vast majority of what you make. Now, that's the individual stock system. Let's look at a put credit spread example from our broader market system we call index options timer. It uses the SPY as its a predominant trading vehicle. We also use the Russell 2000 IWM. And the beautiful thing about SPY, as you can see, we did a Tuesday in the week 3 options. This was back last month. But the beautiful thing about SPY is they actually now have daily options expirations. So you've got an incredible flexibility. Now, we're not going to trade them the last day, but usually we'll trade them about a week out for SPY. So you can see in this case, we were getting a signal here. This was on a Thursday. So this was less than a week later going out to the next Tuesday, right? So you're saying, okay, wow, we can really handpick not just our strike prices, but our desired expiration date. And the important thing about this bottom indicator here in red is it's a oscillator-based technique. I don't give it away here for free, but when you become a subscriber, you get the indicator, the rule settings, all the parameters. We call it rule sheets, so you know exactly what the rules are getting in and getting out. So you learn all this as you become a subscriber. But the principle is, when we're coming out of this oversold period, that's when you should consider getting on a neutral to bullish position for a credit spread. You should be betting that the bottom is in, give or take. But the key is that even if you think the bottom is in, you look at the old lows here, which are around 392 for SPY, and you say you want to be below that. Now, because volatility had jumped back there December the 8th, we were able to sell a 386 put and then buy the 385 put. That was not just to the 392 lows, it was 6 points lower. You say, why would you go that far down? Because we like having that wiggle room just in case. You can see later, after we're already out of this trade, that there's a huge gap down. As you can see, back in mid-December, we were not a part of that gap down. We'd already booked the profit and we had X'd out of the trade at expiration. We let this trade go to expiration and the options expired with no value. You say, uh-oh, no value, that's a bad thing, right? No, you flipped the script, remember? This is now a good thing to let both of these options expire worthless when you can. And the other good thing about that is there are no commissions when it expires worthless. They literally just get wiped out of your account and you pocket that full premium. So just like the insurance company, you're glad when those premiums don't have anything of value at their expiration, and you pocketed the full, in this case, 25% gain. In this case, you see it's a 1-point spread. We're selling 386 put, buying 385 put. So that's $100 of max risk. We're collecting in $20 on each contract that we do. So your net risk is $80. So 20 over 80, again, a 25% return potential. We collected all of that just 4 trading days later. So the beautiful thing about that is you can see that when we put this trade on, we were in the neighborhood of about 397 in here, okay? We were wrong to the tune of about 4 points when it spiked down a couple days later to 393. Now, if you bought calls betting that we were going to get a big rally, good chance you get yourself stopped out on that 1% move against you, that 4-point move on the SPY against you. You're really kicking yourself going, oh man, I got to blow this, or I'm getting blow this trade out, or I've got to get blown out by my stop. At that point, we were not X'd out there. We were able to hold that through that noise. And you see, then you get this huge gap up. You say, well, why didn't you take it out on the huge gap up here the morning of December 13th? Because we're so far out of the money, right? We're now, you can see at 386, at 410, we're 24 points out of the money. That's like 6% on the index, and the expirations later that day. We said, look, even if we reverse, which we did, we gave up 10 points on the SPY. It didn't matter to us because as long as it finished above 386, we were pocketing that 25% return. People would say, well, could you have made more money buying calls if you had the staying power to not get shaken out by that fake out? Those shakeouts are what hurt your win rate. They also not only hurt your win rate, they hurt your trading confidence, right? So the big part of this is that you've got to be able to manage winners and losers. And let's talk about a loser. I don't want to just talk winners here. I want to say, what does a loser look like? This is an example with Netflix, where you'd say, wow, Netflix, this is going back actually pre the breakdown in the stock, but you can see this is showing an example where we were betting on a breakout to the upside in a prior September, and you can see that we thought, hey, the stock's up here into the 607, 610 range. We thought, hey, selling a 600 put with just a few days to go before expiration looks like a pretty good trade. So we sold 600, we bought 595. That's a $500 potential maximum risk. We collect in at least $100, so 100 over our net risk of 400 means that's still a 25% gain potential. So even as the stock prices change and you have to widen out your spreads a little bit, you can still be targeting that 25% gain. But we don't want to take more than about a 50% loss. You can see that this one started to go underneath our 600 strike level. That's where you want it to hold, but even as it spiked down here below that, we said we've got to take this loss, and we're taking a 54% loss 3 days later. So it didn't hang in there like we thought it would. It started to roll down, and you can see it just got worse for Netflix. You don't want to get stuck holding the proverbial bag and taking a full loss. So typically, if we take a 50% or so loss on a trade, that sounds like a lot, but remember, if we're targeting 25% gains, give or take, we can make that up over the next couple of trades. But if you take 100% loss, it's going to take you 4 of those 25% winners. It's going to take you more time to make that bigger loss up. So we obviously will seek to keep our losses smaller than even that 50% when it's not doing what we want it to do. But 50% is about where we just say, okay, it's already hit our maximum. We need to get the heck out and move on. That was showing you a neutral to bullish example on a put credit spread. Some call these vertical spreads as well, right? You may see this on some trading platforms. They're vertical because they're in the same expiration. We use the same number of contracts as well. We don't get cute with ratios or changing around expirations between the two legs. So now if you think a stock or ETF is going to drop, instead of buying a put, you actually do a call credit spread. Notice in all these examples, we do out of the money, meaning that we've got wiggle room. So in this case, if the stock's at 33.5, we're betting it's going to go down. We don't just sell a 33.5 call, we sell a 35 call in this example, about 4% out of the money. So even if it goes up 4% from 33.5 to 35 at expiration, we still can pocket our full premium. In this case, we're selling 35, buying 40 calls to protect ourselves. That's collecting in the $200 of premium. Max risk, of course, is on a 5-point spread, it's 300 because you collected 200. You're risking 500 minus the 200 you collected, or 300 maximum risk if it goes to $40 plus. So again, big gaps are your main concern in this strategy, big gaps against you. And so don't do this with earnings. Also with trades where you're betting on it going down, don't do it with takeover rumored stocks. If it's rumored to be a takeover, the options might look expensive, but it could get a big gap up if those rumors prove to be legitimate. Let's not play that game. Remember, your goal has changed. You're not trying to get a big down move. You're just betting that it's not going to go dramatically higher if you're doing a call credit spread. So you can see we're buying that other leg for insurance, and that gives us that ability to control our risk in case there's some kind of a big adverse move against us. Here's the case with Lululemon, LULU. I know a lot of traders probably don't even follow some of these high dollar names because you may have looked at buying options on them and you're like, man, those options are expensive. But by selling the one leg, selling the 330 call, then buying the 332.5 call, 2.5 points higher, we need to get at least 50 bucks on that. We got 64 bucks a contract. So in this example, if you said, okay, well, then that means that we're risking 250 minus 64, we're risking $186 a contract. So you can see we took in 64 bucks. We actually closed it early and bought it back in for 18 bucks. So we made 24.7% profit over just those next couple of trading days. From a Thursday entry, and you can see we were starting to make a new low here on this green line. And of course, we had broken down previously when they had a bad earnings outlook about a week before. We said, look, there's still more downside here. And we see it drop down these next couple of days here to about 305, 306, and we're going ahead and taking it out early. Okay, so we've still got like another few days to go, and you say, well, by the expiration, in this case, that was the week 4 expiration on the 23rd, who knows where this is going to finish a few days later, right? So the idea is take the bird in the hand, don't try to shoot for the 2 in the bush. You know, knowing that you've got a winner, a 24.7% gain over just a couple of trading days is nothing to sneeze at. That keeps building your portfolio, and it keeps your win rate high, keeps your confidence high. You get it back into cash and move on to the next opportunity. Here's a call credits, for example, from our index options timer using SPY again. Now we're coming out of overbought mode here. So now we're getting a signal that this should be peaked and should be headed lower. But the more important point is should not be headed much higher. This is a big, and so we got bearish right in this neighborhood here, okay? You see that we're trading about 395 or so on SPY. This is a big difference from when we first went overbought on this oscillator. Do not try to bet that the market's going to come down when it first goes into overbought territory. That is like one of the beginner mistakes in using oscillators, is to assume that overbought is bad and therefore it's, hey, it's going overbought, I should bet against it. Because as it stays in that overbought territory here, you can see I'll put a big rectangle around it. What's the price action doing? It's rectangling to the upside. That's a big uptrend, right? You don't want to be betting against big trends. So we actually wait until it comes out of that overbought territory for SPY and IWM to take advantage of those opportunities here. John Jay asked about, he saw my debit spread presentation too. What's better, credit spreads or debit spreads? If you want maximum win rate, credit spreads are going to give you a better maximum win rate. We tend to configure debit spreads to have more of a growth in income, kind of a hybrid. But this is credit spreads are really the best for getting that high win rate, looking for 70, 75, sometimes even 80% win rates over time in given periods of time, and saying, okay, we can stick with that for, in this case, a nice quick 20% gainer over 3 trading days. Notice we were initially right as it popped down, then it zagged back up to where we were slightly wrong. But the key here is that we sold 406 calls, right? We bought 407. See how that's written? So if you sell a 406 call, look, the index peaked out over just about 402. We were still giving ourselves like a percent above that to sort of give ourselves a lot of wiggle room. So when it has a little bit of an adverse move, we're not sweating it. So you can see, bought it back in, after collecting 20 bucks a contract, bought it back in for 4 cents. So if you're doing a typical 1 point spread on $1,000 invested, that would get you typically in the neighborhood of about 8 contracts. That'd be $960 of max risk. And you're taking in, you can see on that 12 contracts, about 180 bucks. So it's not a huge number, but you're saying net of about 180 bucks, give or take, you're saying in 3 trading days, nothing wrong with that 20% gain on your money for 3 days work. So the idea is that, okay, yes, we're giving up the doubles, the triples, the quadruples, but we're also giving up the low win rate that usually comes with those more aggressive options trading strategies. We're saying, okay, look, I know a lot of traders who will try those aggressive strategies, and then it goes through the typical stop out, stop out, stop out approach as a buying strategy, and traders will say after 3 losers, I'm out. We don't want that, obviously. We want to keep you in the game for the long haul. There's nothing like a high win rate to keep you feeling confident and also keep you consistent in reaching your objectives, which for a lot of credit spread traders is more of an income driven mentality, right? Saying, how can I generate more income on my cash? You say, I don't know about buying the market here, and that's an understandable concern. You say, okay, well then we want to have a way you can get in and, more importantly, get right back out, manage your risk, and also manage your win rate and your confidence, and also be very, very risk managed. The beautiful thing about this is when we book a profit, we don't rush right back into another trade right away. We'll wait until we get the right setup. So our holding periods here can be anywhere from 2 or 3 days up to 10 trading days, but a lot of times we're about a week and a half out before our expiration, kind of maximizing that time value that we can pocket on a week-to-week basis. Like I said, anywhere from a trade a week to 2 trades a week, so it averages 4 to 8 trades a month. You can see that our credit receives going to be a minimum of 20%, up to 30%, but usually around that 25% target is really our sweet spot. And you can see that it doesn't matter if you're doing a 1-point spread, you're going to typically risk $80, collecting $20, there's your 25% return. On a 2.5-point spread, we'll collect in at least a $50. That means we'll risk $200, 50 on 200 is a 25% return. So I showed you with the Netflix example, if we're going to have a 5-point spread, we're going to take in at least $1 of that 5. So we'll risk 400, take in 100. That's a 25% return. So those objectives haven't changed, even though the reason we adjust those is because sometimes the price of the stock requires that as you get into higher price stocks, so the spreads widen, but we're still looking for that same 25% or better return typically. So when you combine this credit spread structure with our proprietary trading methods, that's how you generate higher win rates. So like I said, part of the first objective is don't target too big of a profit, right? If you're targeting 50% credit on your trades, you're going to have a lower win rate because you're going to be too close to the money. You're going to get stopped out on too many fake out moves against you. But in this case, when we give ourselves that wiggle room with the methodology that we're teaching you, introducing you to here, you learn in depth as you become a subscriber across not one but both of these programs, then you can start stacking your gains over a couple of different trading systems, one that's trend based for stocks and one that's kind of trading range based for the broader markets. So this shows you on a model $50,000 portfolio, if you're putting in $10,000 to trade over 2 years, you'd be up $36,250 in total profit, adding up all gains and losses before commissions. So the idea is that, look, okay, you say, hey, past performance doesn't guarantee future results, but we know a lot of people had trouble last year in the markets. We didn't. We were very pleased with our results last year, a 72.4% win rate, even when everybody was not happy with what the markets were doing. So what I've set up for you here is a high win rate package that you can really benefit from, this really consistent approach to how you take money out of the markets. It's all about cash flow, right? Cash is king. And the problem though is that if you're sitting on too much cash because you're worried about the markets, you're getting eaten up by inflation. Yes, I say inflation's coming down. I don't think it's going to come down to that magical 2% rate that the Fed's hoping for anytime soon. So the reality is you've got to have a way to beat inflation and make your cash work for you, not just be sitting on cash, right? Cash flow your portfolio. So what we've set up for you is that if you were getting 12 months in my trade alerts from my credit spread trader service, typically that'd be $197 monthly list price. Multiply that times 12, you're $2,364, which again, we showed you how you can make more than that. But the idea is that I'm going to actually give you more here today. I'm going to throw in my index options timer service to give you the enhanced number of trades and also give you the diversity across both a trend following strategy for the stocks and a trading range reversal based strategy for the markets. So that you add in those two pieces, basically you're up to, you can see $4,700 plus, but I'm going to give you a lot of other bonuses here too. I'm going to give you my weekly video training. So I'm going to every week tell you what I'm seeing in both of those portfolios for opportunities, as well as recapping the past trades. I'm gonna also give you the settings and rule sheets for both of those portfolios. I just ask that you just use them for your own benefit. No sharing of those, because we want to keep our edge strong within our subscriber base. So you're going to get both of those settings and rule sheets, and you're going to get access to me and my analyst team via a dedicated special email address that I give you when you become a subscriber whenever you've got a question. Total value of $4,700 and change, but actually it's even more, because I'm going to give the first 23 buyers today access to not one boot camp, my credit spread boot camp. That's a $297 value, but I'm going to also give you my market timing boot camp. Market timing is so important with these strategies. That's another $297 value. Each of these boot camps is several hours of training a piece, so that we're stacking another $594 value for you on top of that alert service value. When you get the real-time email and the real-time text alerts to your smartphone to all of my trade alerts for both the credit spread trader stock-based credit spreads and the SPY and IWM index-based credit spreads on my index options timer program with the boot camps. When you act today, you can see that's over a $5,000 package value, $5,300 plus. I'm marking that out and saying, you know what I'm going to do? I'm going to give it to you today, cover you for the next year on both of these systems. So for all of 2023 and into late January 2024 for a one-time investment of just $393. Am I insane? No, because my belief is that when you get started at this incredibly low starter price point, you're going to see the value that Big Trends offers you. Now, quickly, I'm going to walk you through this page. We keep our order pages really simple here, but it's members. It's not www. It's members.bigtrends.com/CST12. CST, the number 12. Okay, when you pop that into your chat box there, I'll see if I can pop it in real quick for you, actually. And I'll send it to everybody real quick here. That the idea is that, look, when you take advantage of this offer, we're going to help train you how to do this, and you're going to see that it's just going to really boost your trading confidence, and you're going to really look forward to your next trades, frankly, because you're going to see how consistently these work. So members.bigtrends.com/CST12. Real quickly, when you pop this page up, this is what it looks like. Our order pages are incredibly simple. I'm a big believer in the KISS principle. Keep it simple. You can always call us toll free at our 800 Big Trends line, or you can email us clientcare@bigtrends.com. But you see, get your billing information here on the left side, whatever credit card you want to use, or if you scroll down the page, you can also use PayPal there in that orangish yellow button there at the bottom. We're big on being real frank in our 23 years plus in business to show you what the terms and conditions are. So you do need to review those terms and conditions and click that box. So you got all of your information in here. You're going to get the 12 months of the credit spread trader, but I just added in this extra bonus for Traders Corner folks to get the 12 months of the index options timer too. So know that you're getting not one, but both of those credit spread trader systems and programs working for you. We'll just basically add it on to your subscription. So you're getting not one, but two 12-month subscriptions. It's just not listed with that index option timer piece. But trust me, 23 years in business, we're going to do it right for you with both of those programs. So it's something you really want to take advantage of at that incredible 90% plus off reduction here when you act today, and you get the 2 boot camp bonuses, more than 6 hours of dedicated training as well. So, if you have any questions, pop them in real quick, as I've got to run just a touch early here in just a minute. I'll hand it back over to Rob. But as I mentioned, John Jay said, debit spreads versus credit spreads, which is better? If you want consistency, you want high win rate, credit spreads is better. We typically configure debit spreads to have some growth plus some income, but that's going to reduce your win rate a little bit, but you can shoot for a little bit bigger gain with debit spreads. You'll have a little bit lower win rate. I find that most people that want high win rate credit spreads, especially the way we do them with out of the money options, is really important. Joe Dev says, what about Schwab? Can I use a Schwab platform? If you can trade options on your Schwab platform, yes, you can do credit spreads. You typically need to be approved for the second level more than just buying options. You need to be approved, so you'll have a margin account. So check with your broker to make sure they can set you up to be approved for that. It's typically called level 2 access to options trading. And it's basically just more of an approval on the brokerage side to say, okay, now you're going to still say, I'm going to cap my max dollars at risk on any individual trade. don't ever put more than 10% of your options trading portfolio into any one trade is what we would say with credit spreads. The link, Dan says, okay, let me pop it in real quick. It's members.bigtrends.com. I'm going to go show you this link. It's at the bottom of this page over here, Dan. members.bigtrends.com/CST12. Okay, so make a note of it because I know we've got more great speakers coming up, but you're going to definitely want to take advantage of that offer with the boot camp bonuses, with not getting one, but both of the credit spread systems working for you for just a one-time investment of $393, covers you for the entire next 12 months. I think you're going to love it. If you've got any questions, let us know. We'll be here to help. Definitely OCO orders, Joy Dev says, I mean, basically it's just, you don't need to worry about that so much. You place it as a simultaneous spread. So it's placed like I know on like the Thinkorswim platform, it shows as a vertical spread. TradeStation, all these other big platforms. You can use pretty much any platform that you can trade options on, where you say, I'm going to sell this one and buy this other one at the same time. So that's called a vertical